Welcome back. Well, the market's been very volatile, and of course, the genesis of this move is in the currency market and what's happening with the dollar. Let's actually ask Andrew Holland, who's the Chief Executive Officer at Avendus Alternate Strategies, of what he's making of the current market scenario. Andrew, hi, good afternoon. This sort of is bringing back some memories, right, of the 2007-8 phase. Does it look like it could be headed that way, or are we going to get away easily, and would this be a buying opportunity? I mean, how are you approaching the current phase of the market, the global risk off that we are seeing?
Yeah, I mean, we talked about this last time, Anuj, in terms of, we getting to that point when everyone was saying, we're kind of, moving away from what's happening globally, which was last heard in 2007, wasn't it? And whether that was the case this time around. It's simple, right? It's like, when you're crossing a very busy road, you wait for the red signal, or do you try and cross, with your own risk without getting knocked over? I think that's where we are. There's so many risks out there that it's just worth just taking a view and saying, I'm going to let some of these play out. I mean, what's happening in Europe is very scary. And that's where the problems could really arise from. But I haven't gone to the Fed yet. The Fed, the change in language that I heard was that we're now going to wait for employment data to come back into favor. Now that takes time. Even with the higher interest rates, that will take time. Inflation might show a bit quicker, but the jobs data will take time, and that's what's spooking the markets. It's higher for longer because of just being completely reliant on data, and they're making the same mistakes on the way down in terms of the economy as they did on the way up.
That traffic signal example is interesting. Andrew, hi, good afternoon. So are we going to be lower for longer here? You said higher for longer.
I meant higher for longer.
Because that's not how it's played out here. Things have come back very, very swiftly each time. Yeah, go on.
So here's where it is that when I was saying higher for longer, I meant they're keeping rates lower and not addressing the liquidity. It was still expanding, and the tightness in the labour market was there. So they're coming in very late, and they're still data dependent. So it could only be one or two things, right? You've had expectations of a kind of pivot going away. So higher rates. That's the first kind of not shock to the market, but against what the market was hoping for. Second is it's going to be probably longer than the market expected, and therefore earnings still have to be downgraded, and that's the next leg. And I still think the market's trying to grapple with that point as well. So it's gonna affect us because the risk-off sentiment is going to be there globally. And if you just look what's happening in the currency markets, it's telling you everything you need to know. So the unintended consequences of higher rates is what the market's getting nervous about now.
Hi, Andrew, you're clearly sounding a little bit cautious, particularly in the near term. But in the past, you've been fairly positive on a couple of sectors, namely FMCG and telecom. If we're going to go into a phase where we get into a bit of a tizzy, then will there be sectors that you'll be looking to chip into?
These are the only two sectors I'd be hiding in at the moment. I think everything else, will have that rotational trade if markets were to pick up, for example. But it's clear to me that, whilst a traditional sector like IT was a good place to hide in, its correlation with NASDAQ is still too high for my liking. Therefore, sentiments against NASDAQ, and there's some scary kind of notes going around about charts and where it could drop over the next 6 to 9 months. You can't walk up that down escalator. That sentiment's going to hit the IT sector for sure, because if tech is going down, the economy is going down, and banks are going to have a problem and therefore cut spending. So it's a very simple equation.
Okay. What about autos and some of the other FMCG names, Andrew, which which were doing so well, and it looked like, finally things were coming back for them. Commodity prices were cooling off, supply issues were easing, domestic demand was picking up. Your thoughts here?
Yeah, no, Anuj, if you remember many months back, we talked about a potential deflation trade, and that played out in July, August, which was really good for the autos and the banking sector. But that's played out now, and therefore we go back to the fact that yes, these are tailwinds for the auto sector. It will play through, but of course you've got some profits to be taken off the table. So that's what investors will do in the very short term, because elsewhere they're probably nursing a loss somewhere. So that's what happens, and until we get to that point where people are not quite throwing in the towel, but we're getting there, is probably where it's probably likely to be these sectors will start to perform again. But at the moment, I would have thought that most investors will see these sectors, even though they like them and I like them, as being areas to take money off the table.
Andrew, sorry, did you mention a broad level around which you think market can get to in this leg? I missed that.
No, I didn't mention a broad level, but I think
you have a level in mind. I mean, broadly, what is this going to amount to, according to you?
See, I would say this, Prashant, and I'm thinking more globally, because I'm less worried about India. I really am, but I just don't think we can, kind of move away from what's happening globally in these kind of risk-off trades. Let's say I think the S&P could fall anywhere between another 5 to 10% from here over the course of the next few months. I think our fall would be half of that. So we'll still relatively do better, but we can't just escape that.
Andrew, so going by what you're saying, you believe that June 2022 lows will hold out, because we're a good 10% away from those levels. Is that correct? At least as of now, with the data points that we have, that 15,100 odd on the Nifty should hold out, right?
Yeah, I think anything towards that 16,000 level is when you should really start deploying whatever cash you've saved at that time. Would be the time I'd be looking a lot more aggressively about deploying funds. At this point, given all the moving parts, it's just tough to kind of get that timing for the next leg up, and I don't think the next leg up is coming very quickly.
Okay, well, some of the outperformers are also